Hello everyone and welcome back. In today's lecture, we move one step deeper into the demand and supply framework by introducing the concept of market efficiency. So far, we have learned how prices and quantities are determined. Now we will evaluate whether those outcomes are good for society. So let's begin with the definition of efficiency. Efficiency, also known as Pareto efficiency, means that it is impossible to make one person better off without making someone else worse off. In the context of the demand and supply model, efficiency occurs at the equilibrium point, where the total benefit to society, both consumers and producers, is maximized. This means that the market is allocating resources in the best possible way, given the available information and constraints. Okay, now let's talk about three key concepts. First, consumer surplus. Consumer surplus is the difference between what consumers are willing to pay and what they actually pay. Graphically, it is the area above the market price and below the demand curve. Second, producer surplus. Producer surplus is the difference between the price producers receive and the minimum price they are willing to accept. It is the area below the price and above the supply curve. Finally, total surplus, also called social or economic surplus, this is simply the sum of the consumer surplus and producer surplus. We also introduce deadweight loss, which is the loss in the total surplus when the market is not operating uh, efficiently. Let's look at consumer surplus more closely. The demand curve represents consumers willing to pay. At point J, a consumer is willing to pay price P1, which is higher than the market price P0. However, in the market, they only pay P0, so they gain a benefit equal to P1 minus P0. This difference is the consumer surplus for that individual. If we consider all consumers, the total consumer surplus is the triangular area above the price line and below the demand curve. This yellow shaded area represents the total benefit consumers receive from participating in the market. Okay, now let's talk about producer surplus. The supply curve represents the minimum price producers are willing to accept. At point C, a producer is willing to accept the price P2, which is lower than the market price P0. But in the market, they receive P0, so they gain a benefit equal to P0 minus P2. This is the producer's surplus. If we sum these across all producers, we get the total producer surplus, which is the triangular area below the price and above the supply curve. This represents the total benefit producers gain from selling in the market. Now let's combine both concepts. When consumers buy and producers sell, both sides gain benefits. The consumer surplus and producer surplus together form the total or social surplus. Graphically, this is the sum of the two shaded areas, area A for consumers and area B for producers. This total surplus represents the overall benefit to society from the market. At equilibrium, this total surplus is maximized, meaning the market is efficient. Now let's connect these to price controls, such as price ceilings and price floors. Price ceilings prevent the price from rising to equilibrium. Without the price ceiling, total surplus includes area T, U, V, W, and X. However, when a price ceiling is imposed at P1, the market outcome changes. A consumer surplus becomes T plus V, while price surplus becomes X. The area U and W are lost. Uh, these areas represent deadweight loss, meaning benefits that neither consumers nor producers receive. So price ceilings reduce total surplus and create inefficiency within the market. Now let's talk about price floors. Without a price floor, total surplus includes area G, H, J, I, and K. When a price floor is imposed at P2, consumer surplus decreases to Z, while producer surplus becomes H plus I. But the areas J and K are lost as deadweight loss. Again, these represent the lost benefits that the market would have created under equilibrium. So price floors also reduce total surplus and create inefficiency. Thank you for your attention.